Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals. It's Friday, January 3rd, and this is my inaugural audio blog for 2014. Well, let's start with 2013, which ended with the cartel attempting one of its most vicious Comex opening attacks that I can remember, only to miserably fail in its third attempt to break the June lows of 1182 per ounce and 1860 per ounce, respectively, for gold and silver. Quite fitting, as per the incredible data that I wrote about yesterday in Charts Even We Can Appreciate. That was the title of the article. Gold and silver are more oversold than at any time in history, and by a wide margin. I mean, think about it. Gold and silver, per the MACD, which is the the moving average convergence divergence, is far more oversold than it was in even 1980, let alone in 2008 for both gold and silver. And by the way, the stock market, thanks to government support, is now more overbought than it was in 2000. But I'm not so worried about the stock market. Frankly, it could hyperinflate for all I care. I'm worried about the real gains and losses that are going to be made in the coming years. The gains will, of course, be in real money, and the losses will be in paper assets. Now, we talk about the manipulation that has caused gold and silver to become more oversold than any time in history. Which again, I mean, I can't emphasize enough how incredible it is that this would happen during a year when physical demand sent countless records around the world. I mean, Chinese imports doubled their record levels from 2012. Because of the Indian smuggling, they may well have imported as much as 1,200 tons themselves. And now the Indian government, as I wrote about this morning, is starting to loosen some of those restrictions because they know they're going to lose the elections in May to the very pro-gold nationalist party if they don't. There's 25% premium still on Indian gold over the paper prices. The Perth Mint, which I really wasn't sure how they were doing this year, reported final numbers that sales were up 35% in 2013 versus 2012. Again, of physical gold and silver. Record imports into Turkey, which is a major player in the Middle East. Record purchases by Russia. And even with weak Western markets, record Silver Eagle sales at the U.S. Mint, which, by the way, shut down for 2 weeks in January and 3 weeks in December. As far as the Comex, I give you an update on the December contract. You know, for all intents and purposes, I'm pretty close to declaring this a default. Because the final numbers were that 650,000 ounces stood for delivery. But apparently thus far, only about 150,000 of that, or 200,000, have actually left the registered inventory. I mean, you can't be more transparent in that you're defaulting by having people stand for delivery, but the gold is still sitting in the registered inventory, and we haven't seen anything come in to offset it. So I'm guessing, and I'll watch Harvey Organ's data the next few days carefully, that register number has to decline sharply in the coming days because that gold has to leave. It's standing for delivery, and therefore we should drop from the current level of, I think, about 450,000 ounces, which is nothing to start with, down to closer to 100 or 200,000 ounces. And remember, last year, February turned out to be as big a delivery month as December was. And right now we have a massive amount of open interest, so there's a very good chance that if something major doesn't happen now, that it will in February. Now, as I proved last week in my piece about the tapering mirage, the Fed's QE program was probably closer to $130 billion per month starting in May when interest rates started rising than the $85 billion they've been purporting, let alone the $75 billion that would be part of the taper that's starting right now. Because again, it doesn't take rocket science to show that there was a 10% portfolio loss for a portfolio that has a roughly 10-year duration. You can see what there was 10% capital losses since interest rates made that piddling move from 1.6% up to 3%. Where it stands right now as I speak, and the government is clearly fighting it tooth and nail because if it surges through 3%, who knows, maybe it runs up to 4% quickly. And look, no matter what the published amount, the Fed's going to have to step up QE, and with it risk destroying the dollar and all remaining U.S. credibility, as if there was any left. I mean, right now it's more like a hostage crisis. It's not like anyone trusts the U.S. government, but everyone is holding U.S. treasuries in dollars. and they're scared to be the person that breaks the system. As you'll see in the article I just wrote this morning, it'll be published later today, about Japan. I mean, they're sitting on $1 trillion of treasuries, and they're going to need to desperately sell those things to fund their collapsing finances. And we know, of course, the Chinese have not only stopped buying but are selling. So who's going to be buying if the Fed decided to actually taper? And trust me, they're not going to. As for the final manipulation statistics for 2013, which I published in one of my articles last week, the cartel ended the year by attacking at the 2:15 a.m. open of the London pre-market, which is one of the most thin times of day, on an incredible 143 of the last 159 trading days, or 90% of the time. And by the way, with the big surge as we opened the year, the first 2 days, they hit at 2:15 on both of those days as well. And on top of that, they perpetrated what I call Sunday night sentiment attacks on 20 of the last 21 Sundays, which means that's about 4 o'clock in the Mountain Time, 6 o'clock Eastern. That's when the overnight, ultra-thin paper markets open, and they tend to attack gold and silver at those opens so that people don't get any ideas. Of course, it didn't happen at New Year's Day, which was pretty shocking, and here we are $40 higher, actually $50 higher than we were when they attacked on New Year's Eve morning. Highlighting the insanity of 2013's market manipulation, what I call the Dow Jones propaganda average. It had only one 2% down day all year. Okay, one, and it was the only time they actually even had a 2% intraday decline. That day was June 20th, the day the FOMC first hinted that it might taper if the economy got better. It only ended down that day a measly 2.3%, and frankly, I think that it was engineered to try to scare the market into fearing tapering. So again, one 2% down day all year for stocks, which are trading at all-time high valuations and are supposed to be the most risky assets out there. As for silver, which, by the way, is the second most utilized commodity on Earth as far as number of uses, and 3/4 of all its demand is used for industrial demand. So if you're going to argue that there's some big recovery, silver would certainly do better than zinc and some of the other industrial metals. It had at least 2+% intraday decline, an incredible 135 times in 2013, or 54% of all trading days. And for 6 months has been held just below the line in the sand at 20. I'm looking at it right now at $20.22, as the cartel just has dug in. And remember, this is a level that was first breached to the upside in January or February of 2008, before the whole crisis and before $10+ trillion, maybe $20 trillion were printed. So obviously, silver is an Achilles heel for the cartel, not just the quote cartel, but the powers that be, because there's so little of it out there that they've so overplayed their hand by naked shorting that supply is rapidly drying up right now. And thus, this year's early precious metal surge amidst falling stock markets is quite interesting to watch. As for the economy, 1.3 million people lost their unemployment benefits on December 28th. And remember, that's 99 weeks for most people. So for some, it's even more. I remember when I lost, the only time I ever lost a job back in 2005, it was 26 weeks. But anyway, in the government's budget deal, they decided to spend on all their pork but not extend benefits. So the labor participation rate, if the BLS is truthful, and they should be, because it's pretty obvious that 1.3 million people left the labor force on the 28th of December, we should see an utter collapse in the labor participation rate, even above what we've seen in the last few months in the December report that comes out next Friday. In fact, I wouldn't be surprised if the 6.5% unemployment rate that the Fed initially targeted as its what would end at zero interest rate policy, if it's broken on the downside next week. Of course, that's why the Fed last week said, oh, well, we're not going to use that 6.5% anymore. In fact, we're not going to use anything at all. We're going to keep interest rates low for at least through 2014 and 2015 and likely 2016. So if anyone thinks that what they said was hawkish last week, think again. As for Europe, it enters 2014 at an all-time low unemployment rate, with major EU elections coming in May. We expect major political, economic, and social turmoil in 2014, particularly from the pigs and France. I actually call them the PFIGs, which just approved a 75% wealth tax for the rich, and therefore guaranteed that pretty much any remaining productive capital is going to flee France. And by the way, their economy right now is showing the literal worst numbers in the entire European continent. I think they may even be worse than Greece right now. Although it's a toss-up, and Spain is probably in that mix as well. In fact, last week the Italian Prime Minister said he expects major unrest in 2014. And thus, for once, I'll simply agree. Look, something tragic economically is going to occur in Europe soon. And for those holding money in European banks, earning nothing and waiting the Cyprus bail-in template to be enforced, you are literally whistling past the graveyard. The IMF itself put out another paper last week saying that there's going to be wealth taxes and confiscations, and yet Europeans are still holding money in European banks. It is just beyond belief why people would do that. As for Japan, which I just wrote an utterly scathing article about an hour ago, so again, you'll see it very shortly, the government is about to unleash a massive sales tax increase upon an already morbid economy, in which inflation is surging. They just announced a 5-year high in the November CPI, while GDP growth is essentially flat and real wages have plummeted for 17 straight months. Shinzo Abe's approval rating is at an all-time low, and the yen just hit multi-decade lows. It's worse than 105 yen per dollar, and the scary thing is it's been as low as 360 yen per dollar. And look at all the stress it's caused by it destroying its value from 75 to 105. Just wait till it goes to 120 or 150, which is where it was in 1989 when its market crashed. The final currency war is on, and no one will be spared. And finally, there's India, where the rupee is plunging anew, and May elections will likely oust the ruling anti-gold Congress Party from power, following the draconian government sanctions that came into play last year. The Indian gold smuggling market took literally 3 or 4 months to surpass the narcotics industry as the nation's largest illegal business, causing physical premiums to surge to a record high 25%. Right now, they're actually backpedaling on some of those restrictions because they're going to have to fight with the BJP party to win the votes. So you are likely to see a massive increase in Indian demand this year. Remember, Indian silver demand was a record level in 2013. And Indian gold demand, if you include the smuggling, is estimated to have been as much as 1,200 tons, which is probably 40% of worldwide production. So again, there could be some major changes in India and in this year, and they would all be positive for gold. Well, that's enough for now. Hopefully you understand the gravity of the likely aftershocks of global quantitative easing, which will only increase in the coming years until all fiat currencies are destroyed. This is why this historic opportunity to buy physical gold and silver below their respective costs of production, amidst unprecedented bullish fundamentals, will likely never be repeated. And remember, when the music stops, which it will, if you haven't protected yourself from the inevitable hyperinflation already, it will be too late. Well, thanks so much. I'll talk to you again next week.